Please go ahead.
Best Acquisition Corp. is incredibly excited about the transaction that we're about to walk you through today. By way of introduction, we're a highly focused hospitality SPAC run by blue-chip industry operators. We leveraged our relationships with Rich Handler and Jim Walsh at Jefferies, as well as our Chief Brand Officer, Eugene Rem, to source this transaction. Eugene and Tillman are partners in the acclaimed restaurant group Catch Hospitality and have many years of operating experience together. That familiarity, combined with post-COVID tailwinds, validates to us that Golden Nugget is a generational asset. Tillman Fertitta is arguably the most successful operator in this category and the leading entrepreneur, CEO, and operator in the hospitality and entertainment space. He has built, acquired, and operated his business in both the private and public arenas with great successes and laser-like focus on shareholder returns. Some of the many highlights of the transaction: Tillman himself. He's an iconic founder and CEO with an unparalleled track record, a commanding portfolio of industry-leading brands, significant geographic and product offering, diversity across the portfolio, which has positioned his company to be recession resilient. Geographically, it's comprised of both national and international locations with a product offering which includes land-based gaming, online gaming, fine dining, casual dining, and entertainment. Unique ability to make accretive acquisitions in these unprecedented times, and over $2 billion of owned real estate.
Thanks, Doug. Let me walk you through the transaction. As Doug mentioned, he has a $200 million SPAC. It's going to be merging with Fertitta Entertainment, which is the parent company of Golden Nugget, a market-leading casino, online gaming, and restaurant operator. We're raising $1.240 billion PIPE in conjunction with the SPAC's $200 million. All those proceeds of $1.44 billion are going to go to pay down debt. Tillman will be issued a little over $2 billion in equity that will have 10-to-1 voting stock. If you look at post-transaction what the shareholder ownership would be, Tillman Fertitta will own about 59% of the company. The FAST founders will own a little less than 1%. The FAST shareholders will own 5.6%, and the PIPE shareholders will own 34.6%. From a valuation perspective, Fertitta Entertainment, with its 5 land-based casinos and certain restaurant properties, is expected to do in 2022 $648 million. We're valuing that at 9.25 times, or approximately $6 billion. In addition, for equity, Tillman is contributing 31.4 million shares that he owns in Golden Nugget Online Gaming, which is 48% of the economic interest and voting control of that entity. When you add those shares in, we're looking at a total valuation of $6.7 billion.
So let's look at this transaction versus the comparables. I think it's important to note that I've known Tillman since 2004, where we started doing transactions. I've done every one of his deals from that period of time through today. And I will tell you, and I've done a lot of hospitality deals, I've always been amazed what kind of an operator, how strong he is, how good his team is, how tenured his team is. It is just an amazing company across the board, and the skill set from development on to operations is second to none across the board. And its total focus, since he's been a sole shareholder, that has been around ROI. Up to this point, it's been ROI for himself since he's been private. We think this is just a great backdrop for him to be able to bring shareholders into it and be able to create value for not just himself but others. When you look at the comps, this company is going to have the Golden Nugget online gaming piece of it as part of it. We really think these land-based operators with online presence are really good comparables because they match up well across the board. And I think it's important to note, for the most part, we think it's going to be very valuable that Golden Nugget will be one brand in the country as it relates to that branding, not just with the land-based, but then the complementary aspect of the online gaming piece of it. For the most part, these other comparables have multiple brands as part of it. And the only one that has a similar strategy is Bally's. But they're just now making the transition that they're going to have to put capital, time, and effort to get a brand awareness under that brand for their footprint as we sit today. Then from the restaurant side, if you put the restaurants both on the average sales, average profit per store, Tillman's businesses are going to stand up very favorably across every one of these entities. And his ability to operate, and again, what's unique is that he's been very strong at being able to buy concepts and be able to do more with them than where they were. And that's both on profitability, but also brand imaging and consumer acceptance. And we think at 9.25, versus this comp set, it's a very attractive price point. And then you look at the regional gaming operators, these are strong groups, but they don't have the online gaming piece. And so that, again, this deal is being constructed at a discount to those we think is also very attractive.
And finally, let's look at how GNOG trades versus DraftKings. As you can see, it's a significant discount. DraftKings is obviously a well-capitalized company, but we believe with the operating expertise at GNOG and the market opportunities that GNOG is seeing across the U.S., we think that there's tremendous upside by including GNOG, and very complementary as it relates to what it can do and how land-based casinos can grow at the same time.
So people are asking, why did you take the company public? First off, we were looking at going public at the end of 2019, and then the pandemic happened. And why were we looking at it? Today is an extremely opportunistic world, and there were some huge deals out there that happened in the gaming industry in the last 18 to 24 months that we didn't think that we could capitalize on without being a public company. We're tired of missing out on major opportunities, and casino, hospitality, and entertainment opportunities are tremendously expensive. But our competition for these opportunities are all public companies with significant more capital. We are going to be converting more to a gaming company because it's the old big box theory. Why open up 50 restaurants that do $1 million each instead of a casino that does $50 million? Will we continue to do restaurants? Absolutely. We're extremely excited to do this transaction with FAST. It's our opportunity to get public quicker instead of an IPO and give us more opportunities to get in the market quicker. With the COVID disruptions throughout the United States, there's going to be unbelievable restaurant and gaming opportunities to either through M&A, redevelopment, and rebranding. We're looking for a lot of concept diversity and economic resilient locations. If you go back to 2008, it was suburban America that was hurting, and we picked up a lot of opportunity. This time it's urban America in your downtown areas that are hurting, and we will pick up a lot of opportunities there. Waterfront always seems to be the most resilient of them all, and regional casinos are much stronger than Vegas and other properties right now. We like companies that have strong cash flow, but for whatever reason, at the top, usually management hasn't been able to make the right adjustments to fit whatever times. Our company's been around a long time, and we've always been very opportunistic in these times. We're also the controlling shareholder in Golden Nugget Online Gaming, the leader in New Jersey gaming, and one of the leaders in online gaming in the United States. I've led the company since 1986 through all of its growth since 1 to 2 restaurants. Let's talk about our company for a minute. Our $3.4 billion in 2019 pro forma revenue with some acquisitions. We're diversified in gaming, restaurants, 5 Golden Nugget casinos, 446 full-service restaurants, and 557 total units, which include everything from a Starbucks to other properties that fit us best, along with our retail. We're in 38 states, D.C. and Puerto Rico. We have 41 international units with 4 on the map right now. This is a huge growth vehicle for us right now as the world is becoming one global place where everybody wants to do business. We have the leading online gaming operation in New Jersey, and we'll enter Michigan, West Virginia, and Pennsylvania by 21, and hopefully Illinois in 22. We have a great advantage over other people because of our huge buying power and our huge strength in operations with our casinos, with our online gaming, and of course our upscale restaurant brands, our specialty entertainment brands, and of course our casual dining restaurants. If you look at our diversified revenue that continually makes us strong, which has also helped us in this current pandemic, Landry's and restaurants and hospitality is 72% of our consolidated revenue, where the casinos are 28%. And you can see the breakdown of the right from Lake Charles to Vegas to Laughlin and on. And restaurants, you can see the upscale, specialty, and casual pro forma revenue. Once again, $3.4 billion in pro forma revenue. Our EBITDA is diversified also. You can see where gaming has a huge amount of it at 40%, $741 million of unit level pro forma EBITDA. You can see that gaming did almost $300 million in EBITDA in 19, and restaurants did $448 million. Golden Nugget Landry's has been a colossal hospitality empire for many years now. It went public originally in 1993. I was the sole shareholder. In 2010, I took it private as the sole shareholder. We've continued to grow and had our greatest growth throughout those periods. And we see this as such a great opportunity to grow this as a public company today. You can see on page 16, our broad national network of locations. This is the strength of our company, being where the people are. You don't see us in cities where there aren't people. That's part of the reason that we've been able to be successful, regardless of what period of time and what kind of recession the country goes in. Once again, I've used it as an opportunity every single time. You can see where the casinos are. You can see where our Golden Nugget online gaming, Bet Golden Nugget, will be growing. You can see our international footprint on page 17 continue to grow. Page 18, our company philosophy is we develop, we own, and we operate. That's why we have numerous stores at Disney, from T-Rex to Rainforest to Yak and Yeti's, concepts that we developed and built on Disney properties. We promote a very entrepreneurial management at the property level. We always keep our G&A efficient. One of my principles is no deferred maintenance. You've got to take care of your properties. You can never get behind the curve. We always focus on growth CapEx and M&A that delivers strong ROI. One of my biggest things that I always preach is operational excellence. There are no spare customers. We're in a very competitive business. Restaurants and hospitality and gaming, you always want to take care of your customers. But the biggest opportunity here is, once again, I've always grown my company and buy when others are weak. This is when the opportunities are there. It's such a huge COVID opportunity. This is going to accelerate gaming opportunities because of the tax base it'll create for so many different states out there. Not only are you going to get a lot of states that are going to fast track online gaming, you will see new states, some of the few states that are left out there, start trying to pass bills for land base. 17% of restaurants, or 110,000, have closed permanently since March of 20. 10,000 restaurants have closed in the last 3 months as of December the 7th of 20. As the economy recovers, post-vaccine rollout, and reduced competition that's going to be a fact in the market, and other poorly run companies that could not make the adjustments during these pandemic times, and gaming opportunities where some casino companies are going to realize that have more than one or two in a market are going to realize that maybe we should just focus on one. There's going to be huge opportunity in gaming, hospitality, and restaurants out there that we will seize upon because we are an M&A company. Long-term value creation. When I went public in 1993, you can see the stock went from 12 to 49, a 308% growth. In our industry, most restaurant companies start out hot, but by the time they're bought out or end up going private, they never had a 300% growth. Hitting numbers quarterly and yearly are very important to me, and that's why we're excited to go public again. Our unit level EBITDA growth, private to sole ownership, you can see in 2010 when I went private, we were doing $208 million, and today $741 million. So one thing we can do is growth. Our simple playbook for growth is return to 2019 volumes. If we do that, which we will, we know that we're even going to be a lot more profitable because everybody got fat in the last 10 years, 12 years since the last recession of 2008. And we've all learned that as tough as any recession was before, we never knew we might have to be successful with only 10 tables operating, or only operating outside, or only operating to go. So we're excited about the challenge in front of us to prove how successful we can be. Our near-term focus is on gaming, the big box theory and the iGaming synergies, and of course, select restaurant and entertainment acquisitions of the opportunities that are out there. We'll continue to lobby to legalize gaming and sports betting in new states. At the same time, we'll continue to have some organic growth with some of our select restaurant concepts. We'll always leverage everything we do because of our scale in operations and in purchasing. I have a very seasoned management team with lots of industry experts. I've been around for 35 years, like I said, since there was one restaurant. Rick Leam has been with me for 22 years. My CFO, Steve Scheinthal, 29 years, who heads our general counsel and also heads M&A. Jerry Del Pret, 13 years. Keith Beitler, 28 years. Jeff Cantwell, 31. And Thomas Winter running our GNOG for 8 years. We have a very seasoned management team, and there's levels and levels underneath them with a lot of experience, and we're extremely excited to attack the next opportunities out there. As we move on to the Golden Nugget casinos, no matter where you go around the world, the Golden Nugget's a powerful national brand. It's an iconic, globally recognized wherever you go. It's the one concept casino out there that all of our properties are Golden Nuggets, and they all have the same consistent look and feel. Your customer knows what they're getting when they go there, and that's why they're so popular. We have a very high perceived value in every market we're in. We're one of the leaders, but we have a broad demographic appeal. We cater to the upper middle, but we also cater to everyone. Middle class America is comfortable. We have a razor focus on customer satisfaction. We operate the old way, and our branded food and beverage operations are huge draws to all of our properties. People want to come to our casinos to eat in our restaurants. And what's unique is that one casino might have a Bubba Gump, another one might have an Ocean Club or an Ocean Air for a Landry's, and then on the steak side, you might have a Saltgrass or you might have a Martin's. So it works great, and like I said, that's our great appeal. Our business strategy is, once again, good markets where the people are. We always redo our properties. We once again replace the food outlets with ours, and we leverage our huge Landry Select Club for our restaurants and our Golden Nugget 24-karat Select databases, which the two is well over 5 million active members to help promote. Just some pictures of the Golden Nugget Las Vegas and what we've done with it since 2005. It's the largest hotel in downtown Vegas, 2,419 rooms. Golden Nugget Laughlin on the water. It's one of the premier properties in Laughlin and one of the most profitable, even though we only have 300 hotel rooms, which makes it one of the smallest properties. Golden Nugget Lake Charles is one of the most attractive top regional properties in America. You could put it on the Strip in Vegas, and it's as nice as anything. It's the closest casino to Houston, Texas, just a little over 2 hours. You can see the pool at the Golden Nugget. It's one of the best. That is the Country Club, which has a Chart House restaurant in it and one of the top new golf courses of 2017 in America. The Golden Nugget has almost 1,100 rooms with 1,600 slots. And once again, it's 18-hole championship golf course. And the H2O pool and bar, which is at every single one of our Golden Nugget properties and 8 of the Landry's restaurant concepts. Golden Nugget Biloxi has become one of the leaders in the Biloxi market, 707 rooms. The Golden Nugget Atlantic City is one of the premier properties now in the Atlantic City market with 717 rooms. Just a picture of the Golden Nugget Biloxi. You can see how all of our properties look the same. The Golden Nugget Atlantic City, once again, all of our properties look the same. We have a great history. Like I've said, we're a development company as well as an operating company, and it's something that a lot of people have not done in the gaming industry because most CEOs of gaming companies are hired-in CEOs and they don't have the entrepreneurial vision. We can look at a property, I can look at a property and say it has great bones and let's redo this property, where all they know to do was go hire an architect and designers and say, build me a new property. That's one of the reasons we've been so successful and have great returns on our properties, as you can see on page 37. Ownership improvement, just to show you, on page 38, you can see in Vegas, when we bought Las Vegas, the margin differential between now and then in Laughlin, Atlantic City, was losing $15 million a year. Biloxi was making like $2 million, and this year it'll do $40 million in EBITDA, even during the pandemic. This is a picture of the Golden Nugget Las Vegas when I acquired it in 2005. Page 40. This was a street that had liquor stores and a couple of pawn shops on it that I went to the city and acquired everybody and then closed the street to build a grand entrance. On the left, you can see the new Rush Tower that I built a couple of years later and a big grand entrance. I love to revitalize. The Golden Nugget Atlantic City is probably one of the biggest of them all to turn something around that was losing $15 million a year. It was the old Trump Marina Hotel. On page 42, you can see what it looked like before in the lobby and what it looks like today. Page 43, that was the VIP check-in before and after. This was a pool area up here on 44 before and after. On page 45, you can see the a la Capri exterior before and after. When you see a Golden Nugget, you know what you're getting. This is that enjoyable pool at Biloxi at the a la Capri before and after. On page 47, their steakhouse, our Martin Steakhouse. 48, their poker room, our poker rooms. And if you go to every one of the properties we've acquired, I don't want to picture you to death, but this is basically what happened in every single one. A before room and after room. On page 50, our food and beverage improvement. Golden Nugget, Vegas, Laughlin, Atlantic City, and Biloxi. Their food revenue prior and then after. We use our restaurants to bring people in. And you can see what we've done from a profitability standpoint. F&B is something that casinos have always seen as a loss leader. And these were too. But you can see what we've done with the profitability of the restaurants in these casinos. In Golden Nugget Lake Charles, since we developed this, you can see alone the F&B departmental profit is $25 million. On page 52, Golden Nugget Casinos revenue and adjusted EBITDA from 2014 when we started growing after we came out of the 2009, 10, 11 recession. You can see $79 million to $293 million, 271% EBITDA growth in the last 5 years. And just something that I want to point out is that when you look at the revenue come down between 18 and 19, that was the Lake Charles Bridge. And if you look at the analyst reports for us and LaBerge, you'll see that the bridge was closed for over a year. It affected our revenue and even affected our EBITDA. But the bridge opened back up and business is booming and great. How are we operating? Q3 EBITDA margin this year, you can see we're operating much more efficiently. 41% EBITDA margin versus 31 and 19. Quarter 3 adjusted EBITDA, 78 versus 72, and that's with a couple of markets really bringing us down. We're basically flat. How are we comparing to other properties out there? In quarter 3, even though Golden Nugget Las Vegas is our weakest property right now, in quarter 3 it did over $13 million compared to $22 million in 19. But look at us compared to everybody else: the Wynn, Caesars, MGM, Sands, and Boyd's downtown properties. One thing about a Golden Nugget, because it caters to everybody, we do business when nobody else does. Our restaurants attract people, and we're just better operators. Our third quarter comparison for you to see: Golden Nugget Biloxi is up, Lake Charles is up, Laughlin is up, and Atlantic City is down. You got to remember, we were not open the whole quarter, and when we did open, you could not take your face mask off. There was no food or beverage, and you could only take your face mask off to have a drink of water if you were dehydrated. And those were the rules from the governor. And we still did $6.7 million. Golden Nugget Casino's October performance. This is really the first month that things somewhat got back to normal. We still had restrictions of at least 30 to 40% in every single casino. In October, our margin was 43% again, but our adjusted EBITDA in the month of October was 27 versus 23. So if we can just get somewhat back to normal, they brought us even further back now in November and December. But if we can even get close in restrictions, which we should with the vaccine, and as we get into next spring and summer, we are going to make more money than we ever thought we could. Golden Nugget Online Gaming. Fertitta Entertainment owns 31,350,000 shares with 80% voting rights. It will be contributed to this company, which will be exciting for everyone. It'll operate as a separate public company, but Golden Nugget will control it. Number one iGaming company in America and in New Jersey. We got Operator of the Year in 17, 18, 19, and 20. You don't get it every year unless you're better than everybody else. We're even a profitable gaming company. As we get into other markets, we will not be as profitable because of the marketing spend to begin with. We feel like we're well positioned to capture 10% share of the projected $22 billion U.S. iGaming market. COVID-19, as I said earlier, is going to accelerate the trend for people to regulate it. Even in conservative Texas, there's huge talk right now of approving some form of online sports and iGaming. Industry-leading monetization, $7.7 thousand per player, which is higher than everyone else. And like I said earlier, the markets that we're going in. We were the first iGaming company to have in-house live dealer a year ahead of everyone else, and first to launch their own video slots. We are always on the cutting edge of everybody else in online gaming. Page 59, you can see the growth from 16 to 20, and we expect this 360% revenue growth, I would surely hope, will continue every 5 years as we are now, if not a lot quicker, just because this is only one market. You can see nothing but growth ahead. Once again, on page 60, our awards. Our hospitality restaurant division, 238 upscale restaurants, 163 casual, and 45 specialty. We have a great proven track record of growth through acquisitions, and we continue to always work on improving our margin. Some of our high-quality, diversified concepts. Some of our entertainment venues, the Tower of Americas in San Antonio and Go Rio, the Boats in San Antonio, the Kima Boardwalk outside of Houston, T-Rex at Disney, So just to make the point again, we are not your normal restaurant company. With all of our Disney and Universal units, and then our specialty and waterfront concepts on the next page, you'll see that we do nearly $1 billion in revenue in these super specialty locations of these huge, big waterfront properties all over the country, or these big, high tourist locations around the country. We have a huge history of doing acquisitions. From the beginning, when I went public, done over 25 major acquisitions. This doesn't include one-offs and two-offs and small acquisitions. We've acquired over 6 public companies with over $3 billion in acquisitions. And a lot of these were even done as a private company from 2010 to today. So I was really one of the first people to really start M&A moving in this country. That's when private equity and others started, watching my success. But we do it better than everybody else. Our due diligence is better than everybody else. We use our purchasing power and our operations ability to improve that private equity doesn't have the ability to do. Just some acquisition history when we bought Saltgrass, what the margins were, Bubba Gump, Martin's, Ocean Air, Chart House, and Rainforest. Industry-leading unit-level economics, our upscale brands, and you have to remember, this is a company with 500 restaurants, and to maintain these averages. Upscale, 5.7, over 900,000. Casualty, 4.3, over 700,000. Specialty, 10.5, over 2.1 million a unit. For our total portfolio, doing over 5.7 million and over $1 million in unit level EBITDA. Significant revenue and EBITDA growth through organic and strategic acquisitions, as you can see from 93. When I took the company public, I was doing $34 million and $7 million in EBITDA. By the end of 93, that was in August, and I think our stock went at 12 and closed at 24. In 98, you can see where we were, how quick we grew, but yet today you can see where we are. And I haven't even really tried to grow in the last 10 years. I didn't wake up every day and say, let's grow our company. It's more of opportunities just jumping in my lap, and I seized upon them. Our hospitality division and restaurants in the third quarter, revenues. Now, you've got to remember, most of the country was still shut down to a degree. But yet our unit level EBITDA still was $52 million. And even though our revenue was off by almost $140 million, our margin, we maintained the same. When you look at us compared to some extremely well-run companies, our margin was unchanged. Cheesecake Factory was negative almost 8. Texas Roadhouse, 2.2. Blooming Brands, negative 2.2. And they did an excellent job. Do not think that all these people did not do a great job. Our October preliminary results, once again, that was the only month that was somewhat normal. Consolidated financial statement. Rick, I'm going to take a break and let you have it.
Thank you, Tommy. Once again, I think you can see the growth in this company from 2010 to the pro forma 2019. Over that period of time, both in revenues as well as unit level EBITDA. And if we go to Q3 and talk about the ability for the company to manage its costs, since you couldn't really manage the revenue side because of the restrictions that the government were placing on every business, if you just notice that we took our cost structure down significantly. And so one of the things that will happen, I assume for every business, but clearly will happen for ours, is we have learned to operate much more efficiently and much more effectively with fewer people. And so you're going to see labor savings going forward that will stay even as the revenues start to pick up again. And then as Tillman mentioned, October was sort of the first time that you could sense that things were normalizing a little bit. Unfortunately, it didn't last. But during that time frame, we actually beat last year in store level. And again, you can see that margin coming through with significant labor savings and managing, we reduced the menus so you didn't do as much prep. There were things that the customer didn't really get impacted by and yet drove those margins higher.
Rick, let me take this one real quick, then I'll let you finish it off. One of the reasons that we went the SPAC route with FAST is that what you cannot do in an IPO is do projections, but with a SPAC you can do projections. And we felt like coming out of a pandemic that we needed to show people where we thought we were going. But what's really interesting about this is I look at deals every day, and it really upsets me when I look at a company that somebody's been operating for 10 years and it's only grown a little or none at all, but then now that they're selling it, they're showing that the company's going to double in the next 5 years. So all the projections are just BS. These projections here are no M&A opportunity and no new stores, even though we have some in the ground right now. This is strictly what is operating today and where we think we'll be with just those. So this is something that we feel like when you look out a few years is extremely conservative. Go ahead, Rick.
Going forward, pro forma and the model projections, we're not thinking that 2021 is going to be a strong year. Hopefully with this vaccine, we should get some good pickup towards the back half of the year. It will continue to be a struggle. We're saying we're down 20% for the full year. In 2022, even though our EBITDA is going to make an improvement over 2019, it's still based on 13% lower revenues on a same-store basis. This 648 does not include any new stores that we expect to open. We didn't want to put a number in here for something that wasn't in the ground and ready to go. 23, first time we really start to get back to normal on a revenue side, flat to 2019. And again, you can see the significant improvement in EBITDA based on those cost controls that we were talking about. So even though 2021 may not be a banner year when it comes to running the business, we still believe it's going to be a significantly cash flow positive year, given how much that we can still manage those costs, and we do believe 21 is going to be much better than 20. And then in 22, you can see the significant leverage that we get as our sales go up, and we still manage that cost structure. From a cap structure perspective, 100% of the proceeds of this offering are going to reduce debt. And you can see that we're down with no primary selling shareholders. And you can see the reduction in debt that on a pro forma basis gets us below 5 times. One of the opportunities in the back pocket is the owned real estate on all the casinos and a number of restaurants. That if we were to go do one of those sale-leaseback transactions, that you end up with getting about $2 billion in PropCo valuation and your leverage down below 2 times. It's not something that Tillman believes is good from a long-term perspective. Long-term, those rents continue to go up, whereas debt can be repaid and then your interest expense is less. But it is there as a solid asset for this business should he determine that that's where he's going to go.
So as you can see, I'm no big fan of the OpCo-PropCo, as Rick just said. So thank you all very much. We appreciate it making the presentation to you today.